Even though 10-year yields have been trading under 3% for 2 weeks, our next guest is still bullish on treasuries. Joe Balestrino is portfolio manager. He's also the chief market strategist at Federated. He manages $15 billion in fixed income, including a $1 billion in U.S. treasuries, part of that portfolio, $1 billion Federated strategic fixed income fund, a 5-year return of 8%. He is with us now from Pittsburgh. Joe, thanks so much for joining us. You have the other side of the trade, from some other heavy hitters, notably PIMCO's Bill Gross, who are short treasuries. So can 10-year prices go up from here?
Yeah, Deirdre, I really think they can. What we have is a combination of much weaker fundamentals, and at the end of the day, the market always wants to trade on fundamentals. And then obviously the current news, whether it's the debt ceiling, whether it's Greece, whether it's Middle East, North Africa, although the oil situation has rectified a little bit. But you have both headline negative news and a building fundamental. We have to remember about 9 months ago, the emerging economy started to tighten monetary policy, and we're seeing that slow down today.
So, Joe, I mean, a lot of people were surprised when the 10-year, the yield went below 3%. That's a psychologically important level for the market. Just how high can prices go? How low can yields go? And by when?
Yeah, I don't want to take this too far. We're not looking for a double-dip recession, but in an era of extreme uncertainty, uncertainty breeds volatility. Volatility brings money to two asset classes, and the predominant one is the U.S. Treasury market. So if we're at about 290 on the 10-year, can we go to 2.5 in the next 3 months? I don't think that's an outrageous situation or even an outrageous expectation.
Okay. How likely is it that the U.S. debt gets downgraded by whatever agency it happens to be? I mean, what would that mean for the Treasury market then? Does that 2.5% on the 10-year even end up looking high?
Well, if we get downgraded, it depends why. Let's put the debt ceiling aside for the moment. If we simply get downgraded, and that's probably the trend, good news or bad news, and it's obviously bad news, our fiscal house is not in order and won't be for the next few years, and that could be a downgrade situation. Think Spain. 2 years ago, Spain was a high-quality bond market. Today, it's a credit market. You don't want to cross that line. If we get downgraded, on the other hand, because of a debt ceiling political fight, I would view that as a buying opportunity and wonder if investors wouldn't use the Treasury market, odd as it sounds, buy the defaulted security because they know it's a political default. It's not a mathematical default. How
likely is it, Joe? Can you handicap it on a scale of 1 to 10? How likely is it that the U.S. debt gets that call against it?
In the near term, I think it's very likely that they get put on negative watch as a result of the political situation. Give it a few years, and I think the number's much higher. I think you're looking at a 60–70% likelihood of a downgrade, over the next 5-year period. It's not a near-term event, but it's a train that's left the station.
What is the most important factor right now driving the Treasury market? I mean, you named a few of them. You were talking about the pressure in the Middle East. You were talking about what's going on in Greece, talking about the debt ceiling. Also, there's the end of QE2, right, this week. Can you rank any of these in order of importance as far as sentiment goes?
And those are a lot of important issues. I think number one in importance, or at least in visibility, is Greece. It's probably followed by the debt ceiling, or actually, coincident with the debt ceiling is the end of QE2. QE2, I do take the opposite side of the equation from some others in that, yes, I understand the biggest buyer may go away, but the reality is the economic fundamentals are weakening. QE1, QE2 both succeeded in driving risk asset prices higher. And at the end of QE1, risk asset prices came down and treasuries went up, and I think what the market's saying today is they expect the same thing to happen. So Joe, the weak fundamentals. Go ahead.
Sorry, I didn't mean to cut you off. I just want to ask you one last thing before we go. The BIS, the Central Banks Bank, put out its annual report this weekend saying central banks should raise rates because of inflationary pressures, alluding to the U.S., the U.K., Japan, with rates near record lows. Any chance of that happening, especially in the U.S., by March of next year?
I would almost say zero chance by March of next year. Bernanke's laid out the scenario of NQE2, sit back and wait, look at changing the language. That probably happens in the fall, best case. And then to the answer of extended period, he defined extended period as 2 or 3 meetings. I think all of that math gets us to at least March of next year. We wouldn't look for Fed funds to change in that time frame.
Joe, thanks so much. Joe Balestrino joining us there from Pittsburgh. He is with Federated.